everyone, to first Energy Symposium of the spring 2019 semester. The talk next week is going to be Michael Wara of Stanford University. He is heavily involved right now in discussions regarding the issues on Pacific Gas and Electric and their bankruptcy and their whether they caused the fires, large part of the wildfires in California, which caused a lot of damage, and whether that was due to negligence, and how all this is working out. So he's heavily involved in that. So we're going to learn a lot of details about legal proceedings regarding utilities in California. So that's guaranteed to be, I think, pretty interesting. Today we have Martin Stuermer from the Dallas Federal Reserve Bank. I met Martin a couple of years ago at an Association for Energy Economics conference, and his paper I thought was pretty interesting, and this is a similar topic and looking at really long-term trends of minerals. He's a senior research economist at the Federal Reserve Bank, interested in macroeconomics, the focus on energy, commodities, and natural resources, and he studies these long-term trends and prices of energy and commodities. And he writes briefs so that they can inform the Federal Open Market Committee and I don't know, whatever they do that helps govern our lives. Martin can tell us. So thanks for coming, Martin, and go ahead, take it away. Thank you. Make sure.
Yes, does it work? Perfect. Okay, so thank you so much for inviting me. I really appreciate this. So I work for the Federal Reserve. We have a group that works on energy markets, on oil markets at the Federal Reserve Bank of Dallas, and we are the to-go regional reserve bank on energy. So every time something happens in oil markets, like over the last 3 months, the people in DC basically look at us and want to know what is going on. And I brief our president on oil markets. We do a lot of outreach to people in the industry, informing some of our briefings. And yeah, this is one part of my work, is policy work, and the other part is research like a professor at a university. And what I present here today is a joint work with Gregor Schwerhoff. He works at the World Bank. And this really looks at the very long-run trends in non-renewable resource markets. The usual disclaimer applies here. So the views that I represent here are not the views of the Federal Reserve System. They're also not the views of the Federal Reserve Bank of Dallas, and also not of the World Bank. That's very important. I also cannot speak about oil markets kind of short run today here because we are still in the FOMC blackout period. So if you have any questions about short run oil markets, I unfortunately have to decline these questions. But everything long run is fine. So this paper is about technological change in resource extraction. And we are trying to come up with a theory here that links extraction technology and macroeconomic development. So I'm really interested in the intersection between geology, the mining sector, and macroeconomic developments. The starting point of this paper is really the discussion about limits to growth. There is this literature starting by Malthus, then picked up by the Club of Rome in the 1970s, that basically says because we have a fixed stock of non-renewable resources, these resources will become scarce over time as we consume them, and that's why the prices of these resources go up, and at some point the world economy has to decline because these resources are essential, and that's why we have these limits to growth. And then economists have argued over the last 20 years that this is a too dramatic view of the limits to growth, namely arguing that technological change in resource efficiency will basically overcome these scarcities from non-renewable resources. The idea is as non-renewable resources become more scarce, prices go up, and that's why society will invest into more technological change, into resource efficiency, and then the energy intensity or the material intensity of the economy, so the amount of materials that we need to produce 1 unit of GDP goes down, right? And so basically we can produce more products and services with less materials, and that's why there is a drag on growth, but there are no limits to growth. However, these models still predict increasing prices for non-renewable resources over the very long run. And they also still predict that the production and consumption of non-renewable resources declines in the very long run. So what we do in this paper here, so this is kind of the prediction from these theories. Basically prices go up over the very long run. And then what we show is that, and this is actually pretty well established in the resource economics literature, that empirically prices over the very long run do not go up for these non-renewable resources. Of course, there are lots of fluctuations, but over the very long run, there is no kind of increase in all of these non-renewable resource markets. So this shows here prices for several major non-renewable resources, namely copper, lead, tin, zinc, and crude oil. And what you can see is huge fluctuations, but you can see a kind of an exponentially increasing price here. And then if you look at production data, production and also consumption of these resources has increased exponentially over time. Very different from the theoretical predictions. So this is the puzzle that we are trying to solve in this paper. So if non-renewable resources are in finite supply on Earth and global resource consumption increases, why do we not observe increasing resource prices over the very long run? And the kind of line of arguments that we are trying to make here is to say that the finite resources is a little bit more complicated, right? Because the resources in the Earth crust, the amount of resources in the Earth crust is actually huge. But most of these resources are not economically extractable with current technologies. Right? So there are lots of copper in the Earth crust, but most of that copper is not recoverable with today's technologies. The fraction of the resource in the Earth crust that is actually extractable, that's what we call reserves here. And these reserves, they can increase due to investment into technological change in resource extraction. And then we make the argument that there are offsetting effects of geology and technology that basically lead to stable marginal costs of extraction and hence also stable resource prices over the very long run. This is kind of the punchline of this paper. And if you have any questions, please interrupt. I'm very happy to answer any questions. And what are the implications of our paper? So one is, if we assume that there's continued technological change, as we have seen over the last couple of hundred of years, this basically tells us that in the long run, the supply curve is flat. And that has a lot of implications. Resource wars are basically pointless. Resource cartels are ineffective in the long run because yes, cartels can try to restrict supply, but they only can do this for a couple of years, and then basically competitors can always come up with more supply from different places. And then finally, this is hugely critical for environmental externalities like air pollution or climate change. Because if you assume that fossil fuel prices increase naturally over the long run, there's a kind of a natural incentive for firms and consumers to to use other sources of energy, right? But in the case that prices are stable over the long run, that's not the case anymore. So basically you need some sort of policy to correct for this over the long run. So in my talk I will go over these two different arguments in more detail now. So I will start to talk about the abundance of non-renewable resources in the Earth crust. I will then explain a little bit more the concept of reserves. I go into technological change, then show kind of some of the assumptions that we make about the geology. I try to give you a very short overview over this model. This is an economics paper, so it has a lot of equations. I was told I should try to avoid any equations here. I fit it in one equation, but it's super simple. So we'll see. And then I show you some results, some of the theoretical results, and draw some conclusions. So how abundant are resources in the Earth crust? And so here, this shows you the amount of aluminium in the Earth crust. And I should tell you, I'm not an expert. I'm unfortunately not a geologist. If there are geologists in the room, I especially like your views on this. I want to know if this is correct or not, at least from a high level view. So my understanding is that roughly 7% of the Earth crust, and Earth crust is the upper 1 to 3 miles of the Earth, but 7% of that Earth crust consists of aluminium. So it's huge if you think about it. And that means that the crustal abundance, so the total aluminium in the Earth crust is 1.9 quintillion metric tons. So it's really huge. Copper has a smaller share in the Earth crust. It's I think 0.056. But even with copper, it's still a significant number. It's 1.5 quadrillion metric tons. For gold, it's much less, as we would expect. It's 70 billion, and these are all estimates. Yeah, don't get me wrong on this. And then for fossil fuels, if we take the total amount of hydrocarbons in the Earth crust, the estimates that I read were that they are about 15 quadrillion metric tons of hydrocarbons. And think about it, this is just the crustal abundance. So this is the upper 1 to 3 miles of the Earth crust. Of course, there's much more material in the inner parts of the Earth. But this tells you that physically there's lots of material, lots of these non-renewable resources are available in the Earth crust. But of course, a large majority is not extractable with current technologies. It would be infinitely costly to extract those materials from the Earth crust. And that's why there's another definition here, which is reserves. So reserves are those resources that are economically extractable with current technology. And you can see that these numbers are much smaller, right? The 1.9 quintillions and for aluminium, and then it's just 30 billion in reserves. So that's the fraction that is economically extractable. For copper, it's even 0.8 billion. For coal, crude oil, natural gas, and this includes, of course, unconventional oils. These numbers are also, of course, much smaller than the one that are in the crustal abundance. And then we can see what is the annual output of these non-renewable resources. So what do we extract every year from the Earth crust? And then we see, of course, these numbers are even smaller. And then we can kind of compute, and this is, can I show this? So we can compute, so for how long, theoretically, would the amounts of aluminium in the Earth crust, so I'm talking now about this column here, for how long would they be sufficient to produce at the current rate, right? So if we continue to produce 0.06 billion metric tons of aluminium every year, for how long could we sustain this? And because that number is so big, we could do so for the next 33 billion years. So it's basically an infinite resource here, if we think about it in economics terms. And then even for gold, it's 22 a million years at the current production rate. And for fossil fuels, and again, these are estimates, it's 1.3 million years of current production of these hydrocarbons. Of course, this is a very theoretical number, because this would mean a lot of technological change going forward, of course. And then here we have the same numbers for reserves. So how long could we sustain current production from the existing reserves, so the fraction of resources in the Earth crust that we actually can extract with current technology. And there we see for aluminium it's 100 years, for copper it's 40 years, gold is a little less, it's 17 years, and then for fossil fuels it's all between 50 and 130 years. So smaller numbers. You always have to keep in mind firms only have an incentive to look for reserves at a kind of for certain horizon, right? So it's not, I mean, these reserves are basically found and developed by private firms, so they don't have an incentive to look for reserves for 200 years ahead or something like this. But what we want to argue here is that the total amount of resources is actually for any human civilization standpoint, it's huge. But the critical factor here is extraction technology, right? Because these reserves, they are defined as the fraction of resources in the Earth crust that we can extract with current technology. And this is the thing that we are trying to model here. And this just gives you an idea that these reserves are actually something that is not fixed, right? So these are the reserves, world crude oil reserves since 1980. And what you can see is that they basically doubled over the last 35 years. And this is due to two factors. One is, of course, we have more exploration. But the other thing is that we also developed technologies over time, incrementally, to extract oil from deposits that were not extractable before. One of these technologies, or a whole set of technologies that is kind of typically called with fracking technologies. That's one example for this technological change. And have in mind, these reserves have increased even though we extracted so much oil from the ground. And this gives you kind of an idea how the model works. And yeah, again, I've tried to come up with a version that doesn't show any equations. So the idea is we have this amount of occurrences of non-renewable resources in the Earth crust. And then you basically have two flows. You have exploration, so firms looking for new deposits of let's say copper or oil. But then there's a second channel, which is new technology. So firms invest into new technologies to develop deposits that were not extractable before. And the intuition here is that firms actually need to do this because they basically run out of the high-grade deposits, right? Because they extract from it. So to continue extracting, they need to somehow invest into technological change. And so this basically increases, so you have flows into these reserves, and these are the resources in the ground that belong to a firm and that they can extract from. And that's what they do. They extract oil, they extract copper and so on. And then these resources, they either land in the capital stock, so think about copper and the electrical appliances that are in this room. They go to landfills, of course, but then also some of, especially for fossil fuels, some of these, in that sense, material, but kind of ends up in the atmosphere. But this is kind of the flows that we have in mind in our model. So just to give you some examples for extraction technology, and this is just very, very illustrative. So this is how human beings are extracted resources during the Bronze Age. So how they extracted copper, for example. They had these little hammers, and then they would go in Cyprus, for example, and extract copper from these high-grade deposits in Cyprus. And then nowadays, I mean, this is a digger from a brown coal mining, open-pit mining. You have these huge machines now. So there has been a lot of technological change over this time horizon. These little guys here, this is a human being, right? So they're really huge. So my father, he actually worked for that company, so I would always go and visit these places. So we know from kind of economic history and history of engineering that there has been a lot of technological change in mining. There are also there's of course also evidence for this in the sense that, for example, here for oil extraction in the Gulf of Mexico, and this shows the average water depth of wells in the Gulf of Mexico. And we see that starting in 1945, they only drilled in very shallow water, but then as time continued, they were able to drill deeper and deeper and deeper. And Richard already showed me a couple of very nice examples for this technological change, and he has some data that is not only for the Gulf of Mexico and showing a kind of a similar picture, but also I think that was worldwide, right? So this tells us that there must be some very dramatic technological change here. And then for copper or metals, we have something similar. This is the example of copper mines worldwide. And what we have here on this y-axis is the average ore grade of copper mines. So around 1800, that mine up there mined copper from ores with a 9% ore grade. And ore grade means the concentration of copper in a ton of that ore, right? And so these ore grades, they have come down over time quite a bit. So with technologies nowadays, we are able to extract copper from deposits with ore grades of less than 1%. And there has been a whole variety of different technologies that have been invented over time to being able to do this. And keep this in mind, we were able to do this while keeping prices stable over the very long run. That means the marginal cost of production did actually not increase over the long run, even though we have seen all that technological change. So, and the way that we try to capture this is by having an extraction technology function that exactly captures this idea. We have here the extractable ore grade. We start with a 100%. That means our copper nuggets lying on the ground, pure copper nuggets. And then as the technology level progresses, we are able to mine copper from ores of lower ore grade. This is all that this technology function says. And basically later on, you will see that the copper price over the very long run depends on the parameters for this distribution here. And then, so on the one hand side, we have technology, but what really distinguishes the extractive sector from other sectors of the economy is that that it's intimately related to geology. And one of the reasons why I'm really happy to be here is that I hope to learn more about the distribution of these resources in the Earth crust. Unfortunately, that's something that economists typically don't look at. And I would like to learn more about this. And there's this fundamental law of geochemistry from Arendt. I think he was a German, from 1953, that was his paper, where he proposes that resources are log normally distributed in the Earth crust. And this is some data that I was able to hold off for copper. And it shows you a great quantity distribution, basically. It shows you here the copper deposits sorted by ore grade. And what it tells you is, if you look at, for example, deposits with 1.5% copper content on average, the quantity in these deposits is much smaller than in deposits of lower ore grades. And this is because we're kind of on this upward sloping curve of the log normal distribution here. So the idea is, for high-grade deposits, these are the high-grade deposits, the quantity of resources in there is relatively small compared to the quantity of resources that we find in the low-grade deposits. And one of the things I want to really learn here is also, why is this? Why is there this log normal distribution for these resources? There must be some reason why this kind of formed over millions and billions of years. But this is one of the things that we use here. Yeah, go ahead.
So, term increase is the dynamic that you have a short-term increase in price that raises the profit level, supports new technological development, and then that new supply response comes in and then brings the price down. And then do you see for different commodities, different time constants or different, some parameters around that waveform of the supply response? And then you'd match that with some perhaps different demand response in terms of substitutes or new deployment or manufacturing techniques. For example, the platinum of palladium and catalytic converters. It's so much thinner in the catalytic converter, so that was a demand response. But so let's just keep on the supply response for right now. Is that what you see as the different wave forms and time constants and periods for supply response?
So I agree with your story, and I would love to have that in the model. But the idea here is really to bring together geology and a growth model. And for technical reasons, it's extremely difficult to have these sorts of fluctuations in a growth model, right? Because I'm really looking at the long-run trends. The micro foundation that we have here in terms of how we think about these firms is simpler than this. The way that we think about this here is you have an infinite small, you have an infinite large number of small mining firms, and they are in a competitive market. And the idea is that there's demand for these resources, and if there's demand for these resources, they need to develop technologies, because the high-grade deposits, they're already extracted. So for being able to continue production, they need to make an investment into extraction technology. And then this extraction technology basically allows them to extract from one specific deposit. And this is highly stylized, I know this, because it basically says that you cannot use that technology for the next lower deposit, right? And this is stylized, of course, but this is the way that this model is getting analytically solvable. So this is the way we think about it. And because that technology is specific for that deposit, it's excludable, which means it gives incentives to the firms to actually invent these technologies. And then basically the cost for, and then we have kind of an entry condition that says, oh, firms will enter the market and develop these technologies if the cost for developing these technologies at least equals the profits that they derive from extracting these resources from the ground. So we have tried to kind of, on the one hand side, think carefully about the micro foundations of this model. But on the other hand, we have to make a couple of stylized assumptions to make this model solvable at the aggregate level. Yeah. Okay. So this is a great quantity distribution for copper in the earth crust. If I had data, I could probably do something similar for other metals. And if you know about data for other metals, please come up to me. I would love to talk to you. So we derive kind of from these empirical stylized facts, we come up with a geological function, which basically depicts the same thing that we have seen before. You have high-grade deposits here, low-grade deposits here. This little arrow shows you the direction of development of technology. So we go from the high-grade deposits to the low-grade deposits. And then the resource quantity increases as the ore grades decrease. And then we put this into a standard endogenous growth model with increasing input varieties. Endogenous growth model because it means that firms use the output produced in that economy to invest it into technology. That's where it's endogenous. It's not exogenous. The technology does not fall from the sky as in many kind of older growth models, but it's endogenous because firms invest output into technology here. Increasing input varieties means that the production of the intermediate goods, that there's some sort of love or desire for including different varieties of products here. Then we have an extractive sector and an intermediate goods sector, and they produce goods, namely the non-renewable resource and intermediate goods, and then they are kind of combined to the final output good. The extractive sector here is fully competitive, and the reason why there is innovation in a fully competitive sector is that we have this geological environment with deposits of declining grades, and that this technology is deposit specific. That's why it's excludable, right? If firms would invent or invent technologies and everybody could use these technologies, they would not invest into these technologies, right? Because they could not kind of derive profits from this. And by this feature here, they become excludable. Others can still build up on these technologies, but firms have kind of the right or the possibility to profit or derive profits from these technologies. And then we basically solve it analytically for a balanced growth path. And then there are two key results here, and this is where the equation shows up. So one is that the geological function and the extraction function, the extraction technology function, that they have offsetting effects. So on the one hand side, the resource quantity increases as the grade of these deposits decreases. And then on the other hand, we have that new extraction technology exhibits decreasing returns in making deposits of lower grade extractable, right? You can think about it, it becomes more and more difficult to drill deeper and deeper and deeper and to develop these technologies. And basically this drag is kind of offset by these increasing returns in the resource quantity as you move to lower grades. And we can show that in a proof that this leads to a constant resource price in the long run. And this resource price fundamentally depends on the parameter for the geological function that I just call here abundance. Meaning, if this parameter is relatively high, the abundance of that resource is also relatively high in the Earth crust. So you can think about aluminium, for example. And in that case, the price is relatively low. And then there's a second factor, which is the ease of technological development. So how easy is it to develop technologies and to kind of push the frontier in terms of these grades of these deposits? And if it's relatively easy to develop these technologies, of course, that also has a decreasing effect on the price. And then obviously, this is for a model with just one resource. If we have several resources, the substitutability between these resources also plays a key role in determining the price. And then the other result is really the growth rate of the economy, and we show that the growth rate of the economy fundamentally depends on these two parameters as well. So the long-run growth rate of that economy is positively affected, so the growth rate is higher if this parameter for the resource abundance is higher. And that's intuitive, right? And the same is for the ease of the technological development. And also if these resources are more substitutable, then the long-run growth rate is also higher. And there are a couple of other factors that I don't want to discuss here. They're one of the standard factors in that growth literature. So the conclusions here are that the resources, so when we ask about the limits to growth, we have to first have a more detailed idea about the abundance of resources in the Earth crust and to understand that they ultimately depend on our extraction technologies. So basically, these resources in the Earth crust are relatively substantial, but they are not extractable with the current technologies. So that's why we have to introduce here these reserves to this type of model, which are basically the fraction of the resources that are extractable with current technologies. And these reserves, they can on the one hand side increase, so firms develop new technologies to increase their reserves, and then they can extract from these reserves. So it basically works like working capital. You can think about it like working capital. And then there is this offsetting effect of geology and technology. And that's very important here because the earlier literature has not looked into this because they only looked at the technology. And when you only look at the technology and you assume that there are decreasing returns in developing these technologies, then you also end up with increasing prices, right? Because it becomes more and more expensive to develop these technologies. And I think this is my explanation why others have not dived into this before. However, the hook here is that we introduced the geology part, which kind of offsets that drag on the technology development here. Because as you move to lower grade deposits, the quantity in there actually increases. And this kind of leads then to the stable prices over the long run, I think for a pretty big parameter space here. The open questions to me here are really, what is the exact distribution of resources in the Earth crust? Is there more data out there that we can use to maybe calibrate such a model? Then one thing that we don't have in this model here so far is technological change in resource efficiency. And given the continuity paradigm in science, it would be great to have a model where we have technological change in resource efficiency, kind of the traditional model, and then add this technological change in resource extraction. I think that would be very crucial for modeling, for example, something like the energy transition. And then finally, I think what also needs to be more explored is the interaction between different types of resources. In these models, we have an extension where we introduce different resources, but I think especially looking into this more carefully from an empirical basis would be highly interesting. So this is my talk. I thank you so much for your attention. I look forward to your questions and suggestions.
Thank you, Martin. I'll start with one question and then pass it over. So I guess, yeah, so you want to incorporate geology with the technology of extraction. How much can we go for with that without thinking about essentially affordability of the consumer, or, you know, the companies are mining materials to go into products and people are buying these products. So is this a future vision, or how can we think about prices being constant over time in relation to the ability for a customer, whoever's going to buy these materials, to either make a product, or for me to be able to afford an iPhone, no matter how much copper it has in it, I have to be able to do that, and that's part of the price, I guess. If I can't afford it, would the price go down because I can't buy it, so there's no price?
Yeah, so unfortunately, economists are really bad in predicting things. And one thing that we are particularly bad in predicting is productivity or technological change. So I can only make an assumption. I can say, oh, if technological change continues the same way that it kind of unfolded over the last 200, 300 years, in that case, that would be good news for consumers, because it would basically mean that for these type of materials, like copper, like aluminium, like crude oil, but also some of the materials that are needed for electrical cars, at least over the long run, these prices should stay stable, right? Because you have these offsetting effects from kind of depletion on the one hand side and then technological change on the other hand. Of course, this is based on an assumption, and it's very hard to predict what the future will bring. But at least for explaining the past, I think that our model provides a very important building block here.
So I think you may be missing some additional fundamental limits. The type of limit I'm thinking of is the second law of thermodynamics, which declared surprisingly early that there were certain limits on what engines could perform that no technology of the time or conceivable in the future would ever be able to surpass. And I think there may be some additional limits of that sort here you're not considering. My guess is that one form this could take would be the irreducible free energy needed for extraction. And one illustration of the need for such a point of view is that actually we've never used anything. It's not gone. Every atom we've ever extracted is still on the planet. It's just that the free energy needed to put it in the useful form has changed. So without that layer, I think there's a space for some fundamental limits between the two that you already gave us.
No, I think the thought about, of course, these atoms, they don't get destroyed, and the copper that was mined years ago is still around, right? It might be recycled. But I think recycling would, and this may be one other thing that we might introduce, is recycling into this type of model. But recycling would ultimately rather go into our direction in the sense that that these resources are very abundant, right? Because you can think about materials in the technosphere, so basically in buildings, in landfills, as also some sort of potential deposits of these materials. With the second law of thermodynamics, I would love to learn more about that. Yeah.
Yes. Does your model of hydrocarbons consider the negative externalities of burning hydrocarbons and then the global warming, which might have a negative feedback loop which would preclude the technologies used to produce them?
No, we don't. And the idea of this model is really to highlight that one mechanism, which is technological change and resource extraction, and how that interacts with the geology. This is really a model about non-renewable resources in more general terms. It's a very high-level model. I think to study the questions that you asked, and I think that's very valuable questions, I would need a different type of model. It's unfortunately not possible to answer all questions in these type of models, because otherwise the state space that I would need to solve kind of explodes. But no, unfortunately we don't have this in this model. However, it informs other models that are important for climate change assessment, because basically our model says that assuming that fossil fuel prices stay stable over the long run is a good assumption, right? Because a lot of these models that do climate change assessments, they quibble with that question, should we assume that fossil fuel prices increase over the long run, or that they might stay stable? And our argument here is if there is continued technological change, it's likely that they stay stable over the long run. Yeah.
Martin, there's a lot in this from my mining days and oil and gas days that I agree with, but some things that I think are important as regards the vernacular that you really need to address. One is when you talk about elements in the crust, for example, we typically refer to that as the elemental abundance in the crust. And those elements, like take aluminum as your example, those elements, you ultimately call that a resource. Well, that is not a resource. To the free energy discussion, that is bound in mineral lattices that is going to be phenomenally difficult to disaggregate and to produce. Could be done at incredibly high cost and high energy consumption. The second piece of it is when you talk about resources, when you talk about, the next step is to talk about resources. And resources are actually the endowment that's technically producible. Reserves, when you use that technology, that is in essence almost SEC terminology used as these are the resources that with technology today I could produce tomorrow. And so I think you need to kind of reframe the kind of abundance discussion. The other thing, the technology piece is interesting, and the only thing I would say is the excludability argument is a really tough argument to make. I think that excludability is incredibly transient. It's for a vanishingly short period of time. And one of the reasons you see sustained production is because of that, because you can take those technologies and one company has a hold on it for a very short period of time, and pretty soon everybody else is using it and using it to advantage and being able to efficiently and economically produce. So the last thing I'm going to say, is that this idea of the trade-off between geology and technology, I think, is another tough question, because indeed you look at abundance and it increases as grade, for example, decreases. So what you're saying is, well, yeah, I mean, I'm losing grade, so I'm losing the unit richness of the product I'm producing, but I'm going to be exposed to a lot more of it, and that's an offset. And I don't think it really is, because the marginal cost of producing a unit is going up. You've got a lot to produce, but your per unit, per ton of resource produced, you're having to spend more, other things being equal.
Let me think about this for a second.
I think I'll just follow on. I think it was partly to my thing. So if the unit cost to produce gets more expensive, the unit per widget has to go down accordingly, right? So my phone has to actually have less copper if the unit of copper price goes up.
So on your first point, this is something I've been struggling with for a long time, because there's an ultimate confusion in the way that the term resources is used between economists on the one hand and geologists and engineers on the other hand. Yeah.
Oil and gas extraction,
Yeah.
it has real financial implications.
Yeah, and you're right. This is a very stylized diagram here. If I talk, and I should have noted this here in this talk. So you have to think about another kind of quadrangle here called resources, actually. Right? Reserves are technically extractable, plus they are profitable to extract under current prices and so on. And then, right, and then you have resources, which is kind of this next quadrangle that I don't show here, that are those kind of elements or kind of that are or kind of those deposits that are technically extractable but not profitably. Or right, or there's high uncertainty around these deposits, about the quantities in there. And then there are all the other occurrences in the earth crust. And then it's even more complicated because depending on the classification scheme that you have, resources are also sometimes called reserve base. Or I don't know, but it's... We talk about that, but kind of, if you look at the USGS diagram of this, it's much more complicated. What I'm trying to do is to really simplify it here and to make it digestible for economists, which is difficult. If I start and talk to economists about the elements, it's very hard. And yeah, as said, if I say a resource, that's for an economist copper or crude oil, basically an element, right? And it's not. In these classification schemes, and for geologists and engineers, a resource is basically one part of this diagram here. And so I fully recognize this. Yeah, any ideas of how to better deal with that are very welcome.
I really think the scheme of use crustal abundance, resource to reserve, useful in your
Yeah.
and shows the scaling of three.
But there's an entire field in economics called resource economics. And their starting point is always this one non-renewable resource that is finite and that is drawn down, right? Yeah. And this is where, I mean, this is not a resource in that sense, right? It's a certain element, and I don't know, it's very difficult. On your second question about the excludability argument, so it's, the way I presented it is pretty stylized. The way that I think about it actually is that you have a technology, and then these deposits, they are all kind of different, so you need to adjust that technology a little bit. So if you have an engineer and he goes on a kind of, he drills wells for a certain geological formation, he needs to make certain adjustments. You know, this is what I think about an incremental change in technology that makes it possible to extract this. But you're right, it's kind of a black and white thing here, right? But this is the way that this kind of model becomes solvable here, and I think there's at least something of this in this story here. And then of course our model also says that once this technology is developed, so this technology is kind of, let's say, changed for a certain geological deposit, other firms can take that technology, but they still have to adjust it a little bit to their specific geological circumstances. And then it's also really a longer term model here. And then, yeah, so the trade-off between geology and economy, and you said that the marginal cost should go up as we go to the lower grades. And this is what I don't see, at least not from the very long run, because if, for example, for copper, the marginal cost had gone up over the last 200 years, we should have seen an increase in the price of copper, right? Because price is ultimately equal to marginal costs.
If the thesis is that technology
Yeah.
can maintain it, yes.
Yeah. So it's ultimately an empirical question, right? And we say that part of that story is that there's some offsetting effect here. Yeah. Oh, I don't know. Yeah. You go ahead.
I have a clarifying question about your model, and you might have already gone over this, but where are capital investments for technological advancements? Where are they in the model? And if they are in there, are you assuming that they're linear, or are they increasing over time, decreasing over time?
I didn't get the last phrase, sorry.
The technological advancements, the cost for it, because it's not, free. Technological advancement companies have to invest in all these things. Yeah. How are you assuming that plays out in your model to end up with the supply and price linearity over the long term?
So the capital invested into technology is basically coming from the output that is produced in that economy. So we have extractive firms, they face a demand for a resource, and as their reserves are depleted, they need to invest into extraction technology. And then they buy these they basically go to extraction technology firms and say, hey, I need a new invention. And then these extraction technology firms, they develop a patent, and they develop this machine, and then sell it to the technology firms. And the technology firms, they basically buy that machine from the technology sector with the output. That's basically where the capital goes there. And then they also have some extraction cost there. And what we are trying to show is to show here is that given these two functions, we get to a stable cost of developing technology per unit of resource that is extracted. Right? So on the one hand side, it becomes more and more expensive to develop these technologies in terms of these ore grades. But on the other hand, if you go to lower ore grades, the quantities that you kind of unlock with this technology, these quantities go up. And we can show that for a relatively broad parameter space in these two functions, we end up with a stable cost per unit to develop these technologies. This is kind of the way that it works here.
I had a quick question regarding the resource versus reserves topic.
Say it again.
On the research versus topic of like sources versus reserves. So I guess when you guys are doing your research, you talk about the reserves being things that have technology for extraction, but is that encapsulated within that reserves box? Is that things that have new technology for extraction, but not necessarily the conditions in the area for extraction, whether that's cultural, geopolitical, any other reasons? Like if there's technology for it, but not necessarily conditions in the area to actually extract it, is that still within reserves, or does that go to a different area?
Okay, so the question is, let's say we have a country like Libya, right? Lots of crude oil. But for some geopolitical reason, because there's war, there are oil reserves, or there's oil in the ground. Is that actually called reserves or not, right? This is something no, so I think the numbers that are presented here, that's a good question. So the definition of reserves is really, they have to, these are the oil in the ground that can be extracted profitably with current technology. And in that case of Libya, if you take a very narrow view of reserves, these reserves should not be classified as reserves. But I think the convention is, because people know that it's there, it's proven, and that under normal circumstances it would be profitable, I think it's still classified as reserves. That's my sense. But yeah, for example, in parts of Congo, there might be very copper-rich parts of Congo, but because there's no infrastructure, for example, it's not profitable to mine it from these parts of Congo, and that's why it's not classified as reserves. So it's a very good question, but there's an entire industry just about classifying reserves and what is a reserve and how do you define that. There are entire consultancies that only do this because it's very important for the finances of these firms, because in this sector we have reserve-based lending, meaning the reserves are used as collateral for lending or for borrowing money from banks. And so that's why these reserves are so important for firms, and they need outside kind of consultants to classify and to check that their reserves are actually there and they are in line with these classifications. So it's much more complicated. This is really a macro model, and we abstract away from most of these things here.
Okay, we'll go with one more. Well, I think we'll end it there then. So thank you for the great talk, Martin, and thank you all for coming.
Yeah, thank you so much for coming.